Good afternoon. My name is Jerry McMillan, and I am going to be sharing with you this afternoon some opportunities for increasing your returns safely via real estate that you wouldn't ordinarily have an opportunity to participate in such a way. And a little bit about myself to get started. You see in the picture here, you see my last housing project from the freshly poured foundation to the completed structure. And I've got many years of experience with financing real estate and real estate projects and project management. I'm educated in business and finance and accounting and 20 years of corporate management experience prior to my current experience in real estate development. Done lots of work in volunteerism with developing new home buyers and the process of developing new home buyers for housing. And that brings me to where we are right now and the capability to offer you this opportunity. And we'll talk some more about me a little later, but that's by way of introduction whom I am and why I am talking to you this afternoon. The value proposition will state right up front. We're offering the opportunity for you to invest in real estate projects. You can invest on the safest mode with a predictable 10% return, or the other option is for you to participate on an equity basis in the projects and potentially gain higher returns. And we can talk some more specifically about what those two options constitute a little later. But those are your two options. Some folks do not have the appetite for variation. They don't have the appetite for uncertainty, and they want to know, I'm going to make my 10%. And in fact, we'll see some data later that says that's probably around half of us. And the other half of us really are interested in, while protecting our principal, we want to see if we can get higher returns while still not throwing caution to the wind. So those are your two options, and we'll talk about more specifically your opportunity to invest in real estate in one of those two ways. Now, if I ask you the question, who determines your levels of return today, and who determines your level of risk, and who determines where your money is invested and where it's not, most of us would answer the masters of the universe. And you might ask, who are the masters of the universe? Well, you know them. They're the household names. They're the names you hear on the daily financial news. They're the names represented by the talking heads on the financial shows. They're the names that have the brokerage houses. They're the names that you'll see in some of the charts that manage the vast majority of our wealth in ways that we really don't understand. And we'll talk about that some more. But a part of what we're accomplishing here is taking control of our wealth management away from the masters of the universe and bringing it back to Main Street, to things we understand that are tangible and that we can see and dissect fully. Now, this particular survey by Charles Schwab, Retirement, they show us that we are very much interested in safety. We want our money, especially our retirement money, to be safe. And about half of us say they're managing their retirement portfolios with investments to manage the risk. And about half are using cash instruments, which is very conservative, and you may actually be losing pace with inflation with cash instruments. So again, we want to talk about safety with better returns. Now, what are the big pension funds doing? Well, after they lost about 5 years worth of asset gains in 2008 alone, then they made a concerted directive to look at alternate investments. And what are alternate investments? They're inflation fighting commodities like real estate, where you can get diversified but reduce the volatility. And of course, real estate, as we know, can have some volatility, but we can understand it, we can see it, we can touch it much more easily than things like stock derivatives and these types of issues. And drilling down, Basically, a lot of them say they absolutely will be using alternative investments, and that's from the Putnam Investments 5 years after the meltdown. That's an interesting study. Now let's take a look at returns. If we look at alternate returns relative to other investments, and you can see two charts by the Wall Street Journal and by Morningstar covering about a 7 to 8 decade period and seeing what the traditional returns have been. You can see relatively small stocks are a little more risky than the Dow Jones large stocks, but they, over the long haul, deliver higher returns, but with volatility, which we'll look at a little later. And bonds, of course, more conservative, but you give up some returns. And then below the risk-free line, you have T-bills, which will keep you right at hand with inflation. And so if you want to stay ahead of inflation, there you have to take some level of risk. It's just a matter of how you manage that risk. And so that's what the relative levels of risk have looked like. And you can see real estate is a very, very good alternative, as well as a hedge against inflation, which you can't say about the other things on the list. Now, looking further at the returns on these broad classes, you can see going down the first column, you've got the broad U.S. stock market and what types of returns it's had. Emerging small markets, real estate investments trust, that's real estate funds managed by the masters of the universe. We've got Barclays Broad Bond Index, Barclays Treasury, U.S. Treasury, short-term and long-term. Now we can see, let's look at the 1 year versus the 5 year columns, okay? Now you can see, let's take a look at the broad U.S. market. And this is as of September 2012, and we can pick up period. But as of this date, the 1 year returns on the broad U.S. markets, 30%, not a bad year, but less than 2% over the 5 year period. So that means there was some turbulent, really bad years in that 5 years. And you got the 1 year to bring you up to less than 2%. Similarly for emerging, that's a very tough 5 year period and had a good year to bring you out of it. Lots of turbulence, and if you're prone to sleepless nights, you really don't want to be watching the statements as this roller coaster ride unfolds. Similarly, let's look at the thrift savings plan, the government-sponsored retirement investment plan for this essentially the 401k of the government employees and military. And you can see the funds across the top. The L's are for a limited period. They have a maturity of 2020, 2030, 2050. Those are the targeted dates for maturity for those funds, and they've been around since 2005. Then you have the G fund, which is the government index fund, and then you've got the fixed income instrument fund, then you have the C funds, the S fund, and then you have the I fund with the international. Now, if you take a look at the C fund, typical corporate fund, you can see 1 year versus 3 year returns, so versus 5 year returns. So again, if you've got these high returns in 1 year to bring your 5 year return up, look at the 10 year return. So you can see lots of volatility in the typical. And if you take a look at the fixed instrument funds, for instance, the number's obviously lower than the riskier, more volatile. And the government instrument, basically T-bill types of instruments, you can see lower returns, less volatility. Since the inception, they've had pretty good returns. The last 10 years, fairly low. And you can see in the last 10 years, only one of these are above 10%. With all of the 1 year and the 3 years and the bouncing numbers, look at it over a 10-year basis, only one of them above 10%. Very interesting. Now, as we take a look at again, that same chart, you can see then where the numbers come from. These long-term numbers involve a lot of volatility. So how can we get these types of numbers without the stomach aches? And one of the ways you can do it that people are not aware of is an instrument called a self-directed IRA. It allows you to invest in a number of instruments, and the publication that is the Bible on that is publication 590. Now, you can maximize your nest egg through investments in real estate in various forms, but just want to let you know that's one option, because you may have an investment portfolio that's large enough to invest outside. But for most folks, your largest liquid nest egg is in your IRA. Now, an interesting set of numbers here, that 5 million people, regular people, roll over their IRAs every year. 5 million people, average $70,000. My daughter just rolled over an IRA in the past 12 months, and I won't disclose the amount. But the other interesting fact is, for all those 5 million people averaging $70,000 a year, only 2% of them are free from the masters of the universe, meaning 98% of us just roll our money to one of those big name houses and experience those topsy-turvy returns. But I'm here to tell you that you can get more predictable returns without the topsy-turvy and not being at the control of the masters of the universe. Now, in case you got ideas, there are certain things that you cannot do. You cannot do self-dealing, and we can talk about that some more. But it's a continuing trend. 321 billion rolled over. Now, here's an interesting look at the red. Only 7.9% of all financial advisors fall under the category of retirement specialists. So all these billions of dollars, and only 1 in 13 of the financial advisors are retirement specialists. So here you've got people giving you advice on what to do with your retirement money, and they're not retirement specialists. In the big masters of the universe, brokerage houses, the advisor houses, the people who are paid to tell you what to do with your money. And I guarantee you that if you ask one of these advisors, only 1 of 13% of whom are retirement specialists, if you call them up and say, I want to do a self-directed IRA in real estate, I'll guarantee you they'll say you can't do it. They'll say it doesn't exist, you can't do it. Point them to IRS publication 590, and they can get educated on it. But be that as it may, I want you to understand that this is the authoritative source of information. And in fact, all IRAs are self-directed. It's just that we direct ours to the masters of the universe versus direct them to higher returns without the topsy-turvy, turbulent ride. So 5 million of us every day, every year, roll our monies right in and just let it ride wherever they'll take us. You have an option. If you're so interested, you can roll your IRA into a self-directed IRA at a custodial institution, exercise a direction of investment to direct the investment, the IRA, which is an entity, which will be the investor in the case of an IRA. In the case of your non-IRA portfolio funds, then you are a direct investor, and these things wouldn't apply. But for self-directed IRA, you roll your IRA to a custodian who does understand that these things can be done and are legal and executes them every day, and then you begin to invest and allow your money to grow faster. A list of existing custodians here. We make no fees from any of them. You can use whichever one you want. I happen to have been a customer of one of them for over a decade, and you can see the relative fees and ratings. Whichever one you use, you will then be able to invest in the types of opportunities that we make available through your IRA, and the earnings go back into your IRA, and your IRA grows faster, and you have control without the topsy-turvy of the masters of the universe. You direct these custodians where to put the money and what investments you have chosen to, such as ours, as opposed to the masters of the universe telling you where they've decided to invest your money. Major difference. Again, two options. You can just elect for a straight flat 10%, or you can invest in the projects and share in the gains accordingly. Again, my name is Jerry McMillan. This is what we do, and we do it well, and we hope you choose to participate with us in doing so. If you're interested, you can contact me by either of these methods, and pretty easy to get started. We can walk you through, and you can begin making higher returns right away. In any event, we wish you all the best. We hope the information has been useful. And now we'll open it up for questions and answers.